We have a question from a subscriber named Elio, and the question is, what is the impact of the currency wars on Brazil, and what is Brazil's role in the currency wars? That's a great question. You know, Brazil in some ways is ground zero in the currency wars. It was the Brazilian finance minister, Guido Matanga, in 2010, who first used the phrase currency wars. That was actually the inspiration for the title of my first book, and called this to the attention of the global elite. Now, what's interesting is at the time, Brazil had one of the strongest, best performing currencies in the world. But this was deemed to be hurting exports. Companies like Embraer was hurting tourism in places like Rio de Janeiro. So it was considered to be a problem for Brazil. So Brazil set out to weaken their currency. They did this by cutting interest rates, making the interest rate lower, making the Brazilian real less attractive. The problem is, and I said this at the time, they were trying to promote growth, they were trying to promote exports and export-related jobs, but I said, no, you're not going to promote exports by cutting the currency. All you're going to get is inflation, and that is exactly what happened in Brazil. In 2013, 2014, as the currency was coming down, inflation was taking off. And it's a shame, really, because Brazil had spent 50 years getting their inflation problem under control, 50 years getting inflation, getting that genie back in the bottle, as we say, and then suddenly the genie was released and inflation was running around Brazil again. So then the central bank had to respond by raising interest rates to snuff out the inflation, but of course that put the economy into a recession, now one of the most severe recessions of any major economy in the world. So Brazil has been very much at the center of things in the currency wars, a victim, as suffering from the currency wars. The problem is the currency wars are not going away soon. In my book, Currency Wars, I identify what I call Currency War I, which lasted for 15 years, from 1921 to 1936. Then I looked at what I call Currency Wars II, which lasted for 20 years, from 1967 to 1987. Currency War III began in 2010. We're 6 years into it, which is a long time, but I expect it to go on for 10 or 15 more years. This won't be over soon. The reason is the currency wars have no logical conclusion. You know, Brazil cheapens its currency, but then the U.S. cheapens the dollar, and Brazil cheapens again. It just goes on and on with Europe, Japan, China, all the major economies trying to cheapen their currencies. Currency wars don't end until one of two things happen. You either have systemic reform or systemic collapse. Unfortunately, I expect collapse. So the currency wars are going to go on, are going to be more urgent than ever, and Brazil is very much at the center of it. Our next question comes from a subscriber named Sergio. The question is, Brazil seems to be very much in the eye of the storm. Obviously, higher inflation, severe recession, higher unemployment, of course, a political crisis on top of the economic crisis. But the question is, have these things run their course, or is there more to come? It seems to be playing out in accordance with some of the predictions I've made about a coming economic collapse and a coming reset of the international monetary system. The question really is, are we there yet? Is this as bad as it's going to get, or is there more to come? Unfortunately, I think there's more to come. There is quite a bit of instability in the world. And look, what you're seeing in Brazil, these are very serious challenges, very serious problems, but this is going on around the world. Growth in China is slowing down. U.S. growth is very weak. The U.S., the rest of the world somehow thinks the United States is doing well. We're not. We're on the brink of a recession. Europe has negative interest rates. Switzerland, Japan have negative interest rates. This is a global problem. It's affecting Brazil very severely, but Brazil is part of a much larger picture. So I'm really looking at this on a global basis. That's my specialty. Of course, I pay attention to Brazil, but I really look at the entire international monetary system, the global macroeconomic developments that are going on, and I just see more and more instability. We have an effort right now to keep the Chinese currency pegged to the U.S. dollar and cheapen the U.S. dollar as a way to give China some relief. That means a stronger yen, a stronger euro. But where does that leave Brazil? If the U.S. is cheapening and Brazil wants a weak currency, they have to cheapen even more. But how much more can they cut interest rates? These are problems. It's all connected. Brazil has a major trading relationship with China, very important trade partner. As China slows down, Brazil will slow down. This is a global problem, very much of a problem for Brazil. So the short answer to the question is, we've been through a tough patch, but unfortunately, it's going to get worse. Things are going to get more severe. The importance of this is going to get more urgent. Our next question comes from Mary. The question is, what signs, what indications and warnings are central banks giving that you can use for making your investment decisions? That's a great question, because unfortunately, every major market in the world is being manipulated by central banks. Look, what do central banks do? They print money. Well, if they affect the price of money and they affect the value of money, that affects the value of everything in the world, every other market, whether it's bank deposits, stocks, bonds, currencies, commodities, etc. They're all affected by central bank policies. It would be nice if central banks just went to the sidelines, maintained price stability, and didn't try to do a lot else. But unfortunately, central banks have this arrogant, hubristic attitude that somehow they can manage employment, manage growth, manage investment, manage aggregate demand, everything in the economy. They can't, believe me, they can't, but they think they can, and as a result, they're intervening in every market in the world. I've done quite a bit of intelligence analysis, and in the intelligence community, we have a method we call indications and warnings. These are signposts along the way. I like to say, you know, I live not far from New York City, and the two major cities in opposite directions are Boston and Philadelphia, and we have one type of restaurant, Burger King, on the way to Boston, and we have McDonald's on the way to Philadelphia. Well, if I get in a car and I don't know where I'm going, and I see a Burger King, I know I'm not going to Philadelphia. In other words, these signposts, these indications and warnings can tell you where you're going. You can see it in central bank policy. We see it in Federal Reserve policy. Our central bank, the Federal Reserve, is paying attention to China. They're paying attention to the UK. Likewise, Brazil is looking at the other major central banks, very much at China and the US. They're all taking cues from each other. Unfortunately, it's a bit of a feedback loop, or what we call a circular firing squad, where everyone's trying to get an advantage, but not everyone can get an advantage at once. The bottom line is that you've got to watch central bank policy very closely. It does affect markets. It does affect your investment decisions. What you need is a method. Unfortunately, central banks have flawed methodology, but for our readers and subscribers, we have very good methodology. We have new models using things like indications and warnings to stay ahead of the curve. Our next question comes from Marilena. The question is, what can investors do to reduce their dependence on central banks and the dollar in particular? Are there things that the Central Bank of Brazil, at a high level, and individual investors can do to get away from the dollar, be less dependent on the dollar and what the Federal Reserve is doing? The answer is yes. The single best way to do it is to have an allocation to gold. I recommend 10% of your investable assets in gold. You know, people think of gold as an investment or a commodity. It isn't really. Gold is a form of money. It's just like other kinds of money. So you have the Brazilian real, you have the US dollar, you have the euro, the yen, China's yuan. Gold is just another form of money, another form of currency. You know, one of the criticisms of gold is that it has no yield. Well, it's really not supposed to have a yield because it's money. If you take a banknote out of your wallet and look at it, it has no yield. That's because it's money. The same is true of gold. But remember, the world is moving closer and closer to negative interest rates. You already have negative interest rates in Europe, Switzerland, Japan. They're spreading around the world. Other countries have them as well. Well, in a world of negative interest rates, the asset with zero yield is the high yield asset. Zero is greater than -1. So gold looks attractive from that point of view. And countries around the world are looking to get out from under the dollar system. China is building its own payment system. Russia is adopting a new credit card system. Countries are diversifying their reserves. Even a figure like Ken Rogoff, I have to tell you who Ken Rogoff is. Ken Rogoff is a former chief economist for the IMF, a Harvard professor, and a very distinguished author of the book, It's Different This Time, one of the best-selling books on economics of the last 20 years. Ken Rogoff recently said that emerging markets, developing economies such as Brazil, should have 10% of their investable assets in gold. That's not me talking, that's the former chief economist of the IMF. So my view is, hey, if it's good enough for China, it should be good enough for Brazil, and it's definitely good enough for me. So again, when you have prominent establishment figures like Ken Rogoff saying that emerging markets and developing economies should have 10% of their assets in gold, that's a very powerful signal. What it means is get out of the dollar, become less dependent on the dollar, get another form of money. You might have euros or some other things, but get some gold. So I think it's good advice for central banks, it's good advice for Brazil, and it's good advice for you. Our next question comes from Claudio. The question is, if you have 5% of your assets in US dollars and 20% of your assets in gold, and you're worried about the US dollar, should you sell the dollars and buy more gold? I would say, first of all, to the reader who submitted this question, congratulations. It's a good thing you've got an allocation of 20% to gold. Personally, I recommend 10%. I think 10% is plenty. It's a personal preference. If you want more, that's up to you. That's an individual decision. I recommend 10%. I don't think I would sell the US dollars and buy gold. 5% is a pretty small allocation to dollars. 20% is a pretty hefty allocation to gold. So I would sit with those percentages if you're comfortable with them. But the one question I would ask the subscriber, when you say you have 20% of your assets in gold, do you have physical gold? Do you have possession of the gold? Or are you in what I call paper gold? Paper gold would be things like gold futures contracts, unallocated gold forward contracts from bullion banks in London, gold ETFs, exchange traded funds like GLD and others. If that's the kind of gold you have, I would get out of those and get into physical gold, where you actually have the physical gold, put it in safe non-bank storage. So if that's what the reader has, good for you. But if you think you have gold and you have paper gold, don't be so sure, because when the system starts to implode, when there's a buying panic in gold, when the price of gold starts to skyrocket, $100, $200 per ounce per day, and you say, you know what, I want to get some gold, or I want to convert my paper contracts into physical gold, you may find that those contracts are terminated, that you don't have the participation in the rise that you expected. The reason you own those contracts is when the price of gold starts to skyrocket, you want to be along for the ride. What you'll find is that banks, dealers, exchanges will terminate the contract. They'll give you yesterday's price, they'll send you a check, but you're not going to get today's price, tomorrow's price, next week, and next month. You're going to be out of the game. The only way to make sure you're in the game when the price starts to skyrocket is to have physical gold.